You know, it may be that you're leaving cash on the table. That is, there are certain tax incentives that lower your tax liability immediately, thereby increasing the cash in your pocket today. Here to tell us about a few of these incentives is Nate BUCHALSKI, Senior Manager, Tax Solutions Practice Leader, and Jonathan WINTERKORN, Senior Tax Manager. Nate, Jonathan?
Thanks, Annette. As the economy has started to recover, we're seeing a need to help our clients reduce their tax liabilities. Today, we'd like to go over a few solutions that may be able to put cash in your pockets today. Jonathan?
Yeah. First, we're going to talk about the R&D tax credit. The R&D tax credit's been around for a number of years now, and we just want to go over a couple of highlights to remind you what's important when looking at your R&D tax credit going forward. The first most important thing is that the R&D tax credit is designed for new or improved products or processes. And we know this is, usually relatively obvious, but when you think about some of the things that you do, they don't have to necessarily be new to the world products. It can be just new to your company and processes that you use to improve either your quality or the number of units produced per hour can both be qualifying projects. The second thing to keep in mind is what are the qualifying expenses. Qualifying expenses for the R&D tax credit include and are predominantly the wages that your own employees spend working on R&D type projects. The second is any supplies that are expended during the R&D process. And then the third would be for contract expenses. Those could be lab fees paid to an outside lab to do testing, or could include design work done by other individuals who have a skill set outside of your own organization. So let's take a minute here and look at an example of an R&D calculation. This calculation is for a taxpayer who is a software development company. They have 35 individuals who are programming. Those programmers make an average salary of $75,000 a year. If we assume that the programming that they do and the scheduling that they perform is related to R&D projects, then based on these calculations, they would have an R&D tax credit for federal purposes of $150,000. And importantly, because this is an Ohio client, Ohio has an R&D tax credit that the client could apply for as well. And in this case, it would be $50,000 that could be used against their CAT tax liability.
Next, we're going to cover the domestic producer's deduction, or Section 199 as it's known. This deduction, and it's important to remember that it is a deduction, not a credit. This deduction came into existence in 2005 at 3%, increased to 6%, and is now at 9%. This is for U.S. manufacturers, and what you really need to do is concentrate on it's in manufacturing, but you also need to think manufacturing, produced, grown, or extracted. And another key is it's in the United States. Most folks focus in on manufacturing, but it's really important that you think about other things, such as are you in the construction industry, you may qualify, or are you a recycler, you may qualify. It's also key that you look at the example if you're manufacturing on an item-by-item basis.
Nate, I know DEEP has been phasing in over time, but for all clients, would 2011 be the fully phased in amount?
Yeah, Jonathan, so they would be. You'd be phased in at 9% right now, and we'll just run through a quick example. A taxpayer has taxable income of $4 million. They manufacture products, and they also, though, resell third-party products. When you look at the qualifying activities, just alone, it represents about 83% of the gross receipts. But upon further examination, when you really dive into the detail, we came to find about 93% of the taxable income ended up being on the qualified activities. This alone was a big savings and resulted in about $120,000 additional savings we wouldn't have been able to find without diving deep into the details.
Great, thanks, Nate. The final topic we're going to talk about today is fixed assets. With the depressed economy and real estate markets being down, we found that many of our clients are going out and taking advantage of this opportunity to go out and purchase real estate for use in their expanding manufacturing operations. By doing this, they've opened themselves for an opportunity of taking advantage of a cost segregation study. A cost segregation study allows you to take the building that you purchased and through a engineering-based study, pull out those assets that will represent personal property rather than those items that were considered part of the building. By doing this, you're able to take assets that would be depreciated under a regular 39-year straight line life and move it to a more accelerated depreciable life. Second thing that we can do is, as the expansion's being renovated, typically there are costs that could qualify to be expensed rather than capitalized. This can bring a great deal to the bottom line.
So Jonathan, I know that bonus depreciation is available in 2011 and 2012. How does that make a difference when you perform a cost segregation study and your benefit?
Yeah, you'll see a big benefit, Nate, in bonus depreciation. And we're going to go through an example here where we're going to look at a study for an apartment building that's been constructed. It's a $15 million apartment building. And below I've kind of given 3 examples of how bonus depreciation applies. But we'll focus on without bonus depreciation and then with 100% bonus depreciation. In the situation where there's no bonus depreciation applies, the first year tax savings doing a cost segregation study would be $225,000 of cash in year 1, which is a great benefit. Also produces a net book value or net present value over the life of the building of $530,000. If we compare this to 100% bonus depreciation, under 100% bonus depreciation, the first year tax saving goes to over $1.6 million with a net present value of tax savings of $800,000. So clearly we can see there's a big benefit to doing a cost segregation study when bonus depreciation is involved. And with that, we'll turn it over to Annette.
Thank you, Nate. Thank you, Jonathan. We have a question from the audience. It seems each year that we are waiting to see if the R&D credit is extended. What is the credit status for 2011?
Well, the IRS, or actually Congress last year in late December, extended the R&D tax credit through the end of December 31st of 2011. So for this year, we do have certainty as to where the R&D tax credit is.
Very good. Thank you.